welcome back to another episode of Policy and Profits. I'm EJ Antoni, joined by the one, the only trader extraordinaire, Anthony Esposito. Anthony, how you doing? How's your week been?
My week has been, well, we have some crazy news out of the Middle East to the side. Nice Father's Day, and the week has been okay, kind of on eggshells at the desk, but all else is good. How are you, sir? How was your weekend, and how are you doing?
I am hanging in. I'd love to say winning at life. Maybe riding the struggle bus a little bit this last week, though. Mark, hey, you're absolutely right. Bringing up the international turmoil. Markets up and down. The data has been up and down, kind of piggybacking on some themes we've had for several episodes now. We're getting a lot of conflicting data, and so it's taking a lot to really dive deep and go through the weeds and try to figure out which way are these numbers actually pointing, up or down, sideways, and try to get a sense of what the market's going to do next.
Yep. No, I definitely agree. It's been the reaction to the Middle East and Israel launching a preemptive attack against Iran has been muted beyond belief. And I guess we're in that spot now. And you had put something out on X about it. Polymarket was out. I grabbed that clip, which we have, of will the U.S. now be involved? So Israel's bombing Iran, and let's just call it no effect, like a 1% move down overnight in the S&Ps. We closed the day down 50 bips. Just to put that in perspective, October 7th was a 4% move down. Russia, Ukraine was a 6% move down on the news. So there was really no effect. Now, you had talked about, can the U.S., with our debt levels and deficit spending where they're at, and shift the kind of conversation away from obviously the thoughts and prayers that are with the Israelis and the U.S. allies in the region. Can the U.S. actually finance a new war? So if we have a 72% chance, let's just look at Polymarket, we have a 72% chance of directly entering the conflict. What does that look like to you as far as our financial ability to enter a new conflict and to finance a new war? Are we even able to?
We're really not, Anthony. I mean, this is genuinely scary. When I look at a tweet like this, I'm very happy to see the second half of it that explains that the American people are very, very, very much against any kind of boots on the ground or even general military intervention in the conflict. Yeah. What scares me is the first part, though, that the market is really betting on it, because this is people putting money where their mouth is. This isn't an opinion poll of should we or should we not. This is people looking at the situation and saying, okay, here's what I think is actually going to happen, and I'm so confident in it that I'm going to put my own money on the line. So again, that's very disheartening, because to your question, we can't afford this. We're at 36.2 trillion in debt right now, but that's because of the debt ceiling. As soon as that's lifted, we're going to be borrowing hundreds of billions of dollars, probably in treasury bills on day one, in order to replenish the Treasury's cash account, which I think is about $400 billion right now. It just got a nice upswing yesterday, but it's going to continue trending down until we get that debt ceiling lifted, because we're spending more than we take in as a federal government. But on top of that, not only do we have to replenish hundreds of billions of dollars in that Treasury general account, which is basically their cash account at the New York Fed. On top of that, we have been conducting what they call extraordinary measures. That's largely where the Treasury owes money to something else, like a trust fund of some kind. And instead of making those payments, the Treasury pauses those payments and uses the money to fund liabilities that have to go out the door today, to make today's payments. That has essentially helped extend how long we can be stuck at this debt ceiling before the Treasury has bills today that it can't pay. But all of that's going to need to get repaid eventually. So at some point, when the debt ceiling is finally lifted, we got to replenish the missing cash account. And we also have to replenish these missing payments. Again, it's largely the things like trust funds. Long story short, you're going to blink and we're going to be at 38 trillion in debt. Yeah. At the same time, yields on our debt are more or less kind of converging at 5% on both the short and the long end of that yield curve. So that means that as new debt is issued, obviously any treasuries on the run are going to be at those rates. But as the off the run treasuries mature and as they need to get rolled over into new issuance, you're also going to be issuing that at 5%. So do the math. You're going to be looking at 1.8 trillion just in annual interest expense for the treasury. That's not sustainable. I mean, I can't emphasize enough how much we really need to hit this with a 1-2 punch of, number one, faster growth so we can get more revenue coming in. But number two, we have to stem the bleeding. And it's not just, it's not just the discretionary spending or the Social Security and Medicaid, things like that we need to take care of. We got to get the defense budget under control. Yeah. We just have to. I'm sorry, we're at a point, if I just look at the numbers here, I'm taking off the political hat for a second. We're at a point where there can't be sacred cows anymore, whether it's the left and their Social Security programs or and other programs, or whether it's the right and defense spending. Everything has got to get leaner. It's got to get more efficient, or we're in serious trouble as a nation.
I think that, what you just said is to me the key. It's more efficient. It's not that even services need to drop or production needs to drop as far as, what we're buying and what we have in arsenal, and as far as defense spending. It's that it's not efficient. If we just eliminated the waste truly along the lines of the DOGE effort, we would be in much better shape. But, everyone's holding on to their purse strings. Everyone's holding on to that little, they're dipping their toe in the bucket, and everybody's got everyone's taking a little piece. And before you know it, you're spending 10, 20, 30x what you're receiving back when you're a government checkbook. And that's the problem. For me, that's the problem. If we just became more efficient, we could have the same services or better services for much less. And that's where I think that's where we need to be. The other thing that's crazy is you talk about the market kind of putting their money kind of where their view is. It's crazy to me that the market is doing that, and they're betting that the U.S. gets involved, that it's very quick, and that we continue higher on what I think then a shift away, lower rates from the Fed, and market is onward and upward. So we've had this massive shock of fear coming out of April. And now not even bombs going off and nuclear facilities being destroyed in Iran by the Israelis can get this market to shake. It's really strange. I had a buddy of mine hit me after everything started Thursday night and say, hey, the VIX is not moving. And he's right. The VIX did not react. The S&P, 1%, that's me getting a donut. The thing moves 1% sometimes at this point. When I go up and I get my little espresso and biscuit and then come back to the desk and I'm halfway done and we're back up, 20 bips. 1% is not a move. So the VIX and the S&P haven't moved. Gold has moved. Oil has moved. But it's really curious to me that the VIX and the S&P haven't. So you would think that with that there was a lot of underlying strength in the economy. And there's a great story and a great path being kind of pounded out by Trump and the administration, and there's no question. But right now, what do we look like? And we don't look as good as you would think, considering the market is as resilient as it is. So if we take a look at some of the charts that have been out, just to kind of break down where we are, the first one we have is the S&P versus the M2 money supply. And we've talked about the money supply before and how off the charts it is. But if you look at the S&P versus the M2 money supply, we are at dot-com bubble levels right now, and we haven't been here since the dot-com. So since 99, 2000. So if you're looking at the valuations of the market, you're looking at a way to kind of look at the market differently and say, are we overvalued over our skis or not? Yeah, we're way over our skis. This is not a good setup for equities. It's not a good setup for long-term returns on equities. Now, am I saying that we're going to crash or go down 20%, 10%, 30% in the next month? No. I was saying that back in December and January and February, and the trade worked. I don't see that right now, this moment, but I do see problems like this, which are concerning, and they're just not being spoken about. So I would ask you with the M2 money supply, is there a derivative effect of this as well, which is negative, which in my mind, maybe I'm wrong, but would be potential for another spike in inflation? As we've seen inflation come down, and you noted very, very eloquently, as always, that we're on an annualized rate right now for the CPI at 1.4%. That's down from Biden's 8.6%. But does something like this concern you with when we talk about money supply, we talk about the level of the market and that kind of wealth creation? Is this an issue as far as inflation?
I think so, Anthony. And some of that has to do with the way things like financial derivatives can be, I think, in my mind, treated overly liquid. In other words, these things can be traded about like cash without any kind of illiquidity premium, if you will, and that can be problematic. But if we really look at M2, we're at a record high right now. Yes, it was trending down, and the Fed did make some good progress, at least initially, when they were selling off the balance sheet and hiking interest rates. But I mean, shortly after that was a pretty short-lived decrease in M2. And it wasn't long after that they then essentially just kept M2 stable for many months, but then allowed it to trend back up again. And now, just in the last report, I think we'll get the next money stock measure within the next week. But the last report again showed M2 is now set a new record in terms of just overall level. Sorry. So what we're basically looking at is another situation where we're not going to get any help from the Fed. They have so messed things up with their balance sheet. And what they basically did was trying to cover for Biden and for the inflation that he was causing. We're at a point now where, as they unwind all of the emergency measures, not that the Treasury did, but that the Fed did, that's going to continue fueling M2 growth, and it's going to continue fueling inflation despite interest rates staying punishingly high. A lot of this has to do with what they did with, and we've covered this a lot in previous episodes, but what they did with reverse repos, what they've been doing with paying banks interest on reserves instead of having that reserve requirement. And what's increasingly frustrating about both of those is that an increasing portion of those interest payments are not even going to American banks, they're going to foreigners. And now those foreigners are using those dollars to purchase things here in America. So again, it's fueling inflation at the same time, enriching the folks who own foreign institutions, foreign financial institutions.
The same problem that the trade deficit has caused, right? We're sending dollars, we're exporting wealth, we're sending dollars abroad. Those dollars come back and buy U.S. assets. Not U.S. citizens and domestics buying it, but foreign dollars using foreign countries and entities using U.S. dollars to buy our wealth.
Mm-hmm. And so again, I really, really worry that once again when we see these when we see these house of cards. I mean, I hate sounding so pessimistic, but I really to me it really seems when we look at the numbers, that's what we're facing right now. When we see these financial house of cards. At some point, you'll note on that graph when you had these big spikes in the past, you get a big downward movement afterwards.
Yeah.
And look, this is a ratio, right? You have M2, but then you also have the equities. So it's not as if one has to go down, the other can go up, and sometimes both are happening at the same time.
Yeah.
In fact, actually, I think that's what tends to happen, right? When you do have one of these big corrections, they tend to coincide with a recession. And so the Fed stomps on the gas and gets the money printer going. M2 goes up while equities are falling.
Yeah.
So that's some of it. But again, I think you're absolutely right to have your eye on that. I think you're right to highlight it for the viewers because it is an issue. It's a red flag.
Yeah. So let's look at some more red flags. And I have one question at the end of all of this. The next graphic we have is the Shiller PE. I talk about the Shiller PE a lot. Mm-hmm. You could look at forward PEs and you can look at reported, and I like the Shiller PE because it's a cyclically adjusted number. So it gives you the inflation adjusted number on the price to earnings. 44 was the dot bubble high. We're at 38 now, going on 39 now. These levels are beyond expensive. You could look at PEs and forward PEs now, and they're beyond expensive. But this is a number where, again, we're back to that old tech bubble, 99, 2000 level for the markets. And then it lumps right back into the conversation of breadth who's carrying the market, where has growth been? Growth has been non-existent for a decade in 490 of the S&P 500 names. So you look at the Mag 7 and they are carrying the market. You go back to the .com, it was all of the tech names,
Right.
the chip names, the internet, the .com names carrying the market to these ridiculous levels. And we're seeing the same things now. And to look at them, whether we're looking at the tech names to M2 ratio, whether we're looking at the Shiller PE, I keep seeing these numbers going back to that era. And interestingly enough, what I've seen recently from a lot of the houses and different sources, a lot of the buying off of the lows in April has been retail buying. So we have retail buying versus institutional selling. That's another really interesting point, because in .com, everybody was starting to gain access to the markets. Everybody was able to get on their computer and go to their E-Trade account or whatever the case may be, Ameritrade, and get on and start pushing these names up. And it almost feels like we have the same thing going on right now, where you have a historic spread between retail buying and institutional buying. And the retail buyer is way ahead. Institutions are selling to them. I don't remember the last time in history where the retail investor, the retail trader, the retail buyer was ahead of the institutional traders. But I would challenge anyone to look back and figure out the time that retail was ahead of institutions and made money before the hedge funds and the long onlys. And it doesn't happen. So the fact that retail's pushing and we're seeing those .com type kind of valuations matching, the levels are matching, it's not a great setup. It's still, like you said, it's another red flag. It's a very high level red flag, but it's something to definitely keep in mind.
Yeah, and Anthony, I think it's interesting in this whole discussion on the retail versus institutional. As you made that comment, I can't think of the last time retail was ahead of the curve and institutional was behind. Right? Mm-hmm. We look at the other big spike here, 1929, on that chart. Right? That was another instance where it was not institutions, but in the second half of 1929 that were plowing money into the market. They were profit taking. It was the retail investor who was taking advantage of these rock bottom margin rates in order to buy stock on margin, and they flooded into the market from essentially from like May or June on, and then they were the ones who were unfortunately caught holding the hot potato, or caught holding the bomb when it went off in October.
Right. Yeah, that's right. I think it was one of the Kennedys in the late 20s that said when his shoeshine guy asked him about stocks and what stocks he liked, he knew it was time to get out. And look, at nothing against shoeshine guys, but when you have the retail investor that dug in, that deep, and you have institution is saying sold to you, the old saying, you say sold, they give you money, sold to you. There's definitely a red flag coming. You had put out, moving along with the concerns we have, you had put out another graphic, which I think we have as far as home builder sentiment. Now, for me, home builder sentiment, there were permit numbers out today and housing start numbers, which were not good. This connects directly to the consumer, right? Because the largest asset that most people have in the country is their home. So if we look at the home builder sentiment numbers, talk to me a little bit about this, because this does not look good. Upper left to lower right to me is normally not good. So talk to me here about the home builder sentiment chart.
Unfortunately, and this starts with the beginning of 21, I think it's not really fair to use 2020 because of just all of the insane volatility that happened. It's kind of useless data, quite frankly. So you start here in 2021, and you very quickly see by the time we get to 22, inflation is really ticking up, and it's not long thereafter that we start seeing those very steep interest rate hikes, which then essentially keep home builder sentiment very, very depressed. And yes, it has some cycles there where it's going up and down. But look, this really deadly combination of high home prices and high interest rates has really chilled the market. And we've gone over that in multiple episodes. But it's not only a matter of it's chilling the market from the standpoint of the buyer, where I, as a potential home buyer, I'm looking at the situation and saying, all right, unless I have a massive, massive down payment, I'm not going to be able to afford a home, since I can't afford the monthly payment, because the combination of borrowing a lot and doing so at a high interest rate just pushes the monthly payment outside of my monthly budget.
Yeah.
Okay, so what about the home builder? Well, the issue for the home builder now is the fact that they no longer have the cash, essentially, to be paying a lot. Excuse me. Let me phrase it this way: they no longer have the cash to pay for the cost of building a home up front. As they increasingly have to finance it themselves, they can't afford the interest rates, and we're also running into the situation where, because there's been such a slowdown in demand for new homes, since again people just can't afford them right now. It's getting to the point where the home builders are building fewer homes, and the only homes that they can really build profitably are luxury homes. The starter home is kind of dead at this point in America. And yes, I'm speaking in generalities. You're going to, of course, find markets where they are still building starter homes, but the numbers are just way down. And the home builders are seeing that in terms of foot traffic being way down. That's been a really big indicator. Not only are sales down right now, so even though construction is down, sales are also down even more. So supply is building, and don't forget, as long as the home builder is sitting on unsold inventory, they're facing what you might call upkeep for that, like property taxes. Yeah. So they're facing additional costs. Yeah. And when they do their modeling, like the Wells Fargo numbers show that projected sales, so looking in 6 months and 12 months from now, are terrible.
Yeah.
So if you're a home builder, why on earth are you going out and building any more homes today? And that's really again, it has just really seriously beaten down the market.
Yeah. It's really funny because I have to tell you just a slightly inside baseball here at the fund. I was seeing divergence in the XHB, which is the home builder ETF, and this thing would not come in. I mean, it was pressing 125 multiple times. It was just a beast, and it was like no one could buy these names fast enough, and no one was selling these names. And honestly, to be perfectly honest, I got squeezed out of a couple positions. I definitely took some nicks in the name because the technicals were just working against price. And even when the signal was giving me the negative, every time I got the negative and got in, just as it started to break, it was like somebody came in and bought the name. So they definitely loved the home builders. The story is falling apart. And I don't say that with a smile. It's not a good thing. I don't know how we're at a spot in the market now after everything we've just been through and after all of this data out there where people, whether it be retail or institution, is buying equities and taking risk on, but they certainly are. The home builders, home values, interest rates, all ties into the consumer. Mm-hmm. And I saw a thing yesterday on consumer credit delinquencies. Again, these numbers are rising to a place we don't want them to be. We don't want 10, 11, 12% delinquency rates on credit cards.
Right.
It's not healthy. We're actually back. If you look at the chart, we're back where we were coming out of the 07, 08 recession, housing crisis. We're moving in that direction. We're within 1%, 1.5% of those delinquency rates. How long can this last before we see real cracks in earnings, before we see real cracks in the jobs numbers, the spending numbers, the GDP? Like, this is all at the core of it, isn't it?
Yeah, absolutely, Anthony. And I would say the part that let me back up and rephrase this. The thing that is really concerning to me when I look at this chart of yours is the fact that credit card balances today, outstanding balances, the amount that people owe on these credit card accounts is so much larger today than it was in 07, 08, 09. Yeah. Back then, people a lot of times they weren't using credit cards like they have been the last several years. Yeah. They were using their home as a kind of credit card, right? Yeah. And we saw what kind of chaos was created back then. Yeah. You fast forward to today, And the credit card situation, in my opinion, is much, much worse, not only because of the balance, the size of the balances, but also what people are putting on credit cards. By and large, today, it's not vacations like it might have been in 06, 07, 08. Or I should say like 05 to 07. Today, it's been rent, it's been clothing, it's been food, it's been car insurance. I mean, you're talking about essentially necessities here that people are having to put on credit cards. And so that's where, again, it really gets scary, because now you're talking about a situation where if that goes south, I mean, again, you're not talking about cutting back on luxuries. You're talking about cutting back on necessities.
Yeah.
That's a much bigger hit, in my opinion, to consumer spending numbers.
Yeah, it's a scary thought. And I think your point to the size of the balances. So if you have a 10% delinquency rate on, I don't know, whatever it is, $1 trillion or a trillion, was it $1.8 trillion or $1.6 trillion? That's obviously a much larger number than a 12% delinquency rate on 500 billion. And those aren't the numbers exactly, but the point being that we might be at a lower delinquency rate, still getting to that all-time high or that peak coming out of the crisis. But the numbers underlying, since we're talking about percentages, the numbers underlying are larger. So these numbers are actually in dollar terms, larger numbers, which is pretty scary. I do think that the market is the market's in a very stubborn place. The market is not discounting anymore. I feel like there was a discount exhaustion, and the institutions were really somewhat ahead of this. And I'll say Buffett, for real, was somewhat ahead of this. We talked about this on an episode a while ago. He was, 50%, over 50% cash heading into 2025, which was pretty nice call. The institutions were ahead of this. There was a lot of Mag 7 selling coming out of the larger multi-strat funds, which was recorded in there. We know it happened. But the market now is interesting, because even with an event like Israel-Iran, you're not seeing a discount. You're not seeing the VIX move. You're not seeing the S&P move. It's almost like the retail dollars that are there are staying there. They're not leaving. I'm not sure why, but I do know one thing. They will either be right. This is going to be very common sense. This is going to be very binary. We're not going to churn here. Somebody asked me the other day, a good friend of mine on one of the larger desks, institutional desks, asked, do you think we just churn for a year or two? That's what our guy is thinking on the desk. And I said, absolutely not. We're not churning for a year or two. Anyone that says we're just going to churn for a year or two, in my opinion, to be somewhat comical, is a bull who knows we're going down and just can't bear to say it. No pun intended. So instead of saying, yeah, we're going up, they say, oh, we'll just churn. We'll consolidate here. Everything's good. Meanwhile, in their heart of hearts, they know that we're weak. So I don't think we're going to churn. I think either the retail investor will force the hand and this thing will lever up and go, which will be extremely dangerous, but for the time being will be a great high. Or we're going to see a real move to the exits, and all that retail money, which cannot manage the risk and cannot manage the hedge and cannot manage the exit, and their only way to get out is to hit the red button as fast as they can. That could get very dangerous, and I do think that is the greater risk we have here. We are 2% from all-time highs with a ton of risk not being discounted. I just don't see it, and we're overvalued, and we're still, to a large degree, over-levered. So I'll leave it on. We talked about what's reacting and what's not reacting. Back on December 27th, I wrote in my note that gold was breaking out of a large wedge pattern at 26.22, I believe was the generic active contract, so the front month contract. We have gold right now up at 33.90. And that move has been significant, and that move was based on the model it was there, and based on that technical formation was just really pretty. I don't have any other way to say it. It was just a really pretty chart. I don't really talk on my morning report about much other than the S&P, just to keep it simple. But I did note quite a few times that gold call was out there, and then I reiterated it quite a few times. Now, what's interesting about gold here is, and I posted this morning a chart that was out on the asset classes and outperformance, underperformance year to date. gold is a massive, massive green bar, up 35% year to date. And then everybody else is a redheaded stepchild, essentially. And I wrote in my, no offense to any redheaded people, I wrote in my note, in that note when I reposted it, was start asking about the who and the why, because this is a real thing. And this is an interesting note that came out of Goldman Sachs. Zero Hedge posted it. It shows what China, because we know that these are sovereign banks buying gold. There's not that much retail buying in gold, not to move this the way it has.
Right.
China is in the red here, what they reported buying. Goldman is in the blue here, saying these are the numbers we're getting from the London Metals Exchange. So just for a second, take a look at how much gold China has bought year to date. So through 2022, 23, 24, now in 25. Take a look at these levels and ask yourself, if we have the who, and China's one of the who, and we can think of different reasons why, think of the why, and then think about why they would lie about how much gold they're actually hoarding and buying. There's really no reason to do that unless they have a nefarious approach or a nefarious angle. This is very interesting to me. This is kind of a it's like a red herring for me. There's a lot of push into gold by very large, somewhat antagonistic enemy states. These banks are hoarding gold and then lying about what they have. I don't know why. What do you think?
I think it's, Anthony, probably the same reason China lies to us about, I mean, almost all their economic numbers, quite frankly. If China is putting out like export figures, for example, you can't trust them. You literally have to go look at every other nation's import numbers across the world and see what portion of that is Chinese, and then add all of that together, which is a whole heck of a lot of work. But that's what you need to do to try to verify their numbers. I mean, the Chinese Communist Party doesn't even publish certain economic figures anymore because they're just really lousy. For example, they don't publish certain age groups' unemployment rates anymore. They infamously stopped doing this a year or two ago with youth unemployment, with teenage unemployment, because the numbers were so bad. I mean, it was 20 or 30 something percent. You know, they had rioting in the streets of some of their cities, and of course the state-run media kind of kept a lid on all that as best they could. Yeah. But they literally just don't report certain statistics. Yeah. I mean, it was laughable how many years in a row the CCP kept saying, look, we're going to achieve 7% growth next year. 12 months later, they announced, hey, we achieved 7% growth last year, just year after year after year. Yeah. I mean, look, even if you're growing like gangbusters, you never hit your targets on the nose time after time again. You don't? So it's just, I mean, it frankly is just kind of silly. Yeah. Now, kind of more specifically, I think in terms of gold, I think it's really, really clear that the kind of worldwide monetary order that we have and that we have had for quite some time now, at least since 71 when Nixon closed the gold window, but arguably you can say it goes back much longer than that. At the end of the day, it's not sustainable, and people are slowly waking up to that. And I think everyone is kind of preparing for whatever the next stage is going to look like. Yeah.
There's that chart. That's a great job by getting that. Thank you. Best producer in the world. Grab that off of X for us. The
best producer ever.
Yeah, I think gold is definitely something to watch. If you're long gold, you're happy. If you're not long gold, keep an eye on it. There's something going on here, and it's there's a lot of risk underneath the hood that we don't see, and we're not discounting. And there's a lot of hedging and positioning going on that we're not paying attention to, whether it be in the financial markets or else. So definitely watching the financial markets. We have the Fed today. I do expect Powell to cut, even though he is overly politicized, biased, and I don't know if he even knows what room he's in. However, I do believe that, and this is just my gut, I do believe that Secretary Bessent and he have had some real heart-to-hearts, and that Mr. Powell understands that his politicized game sitting in that seat is over, and he needs to do the right thing here and cut rates. So I do believe we'll cut today. and we'll see how the market acts. I expect a really strong, hard move up. I don't know how short-lived that'll be, but that's kind of my expectation going into this afternoon.
So, Anthony, do you think then they're going to cut rates even while they continue rolling off the balance sheet? Now, granted, there's almost no roll off in treasuries right now. I mean, it's minuscule, but they are still rolling off MBS. Do you anticipate that they're going to allow the balance sheet to continue to decline, or do you think they might take a meeting to stop the decline, just hold the balance sheet steady?
That's a good point.
And then maybe cut sometime in the future, maybe in the next meeting or
That's
one
a good
thereafter?
Point. Yeah, no, that's a good point. That actually makes perfect sense. So maybe I'll agree with you on that for sure. I think that makes sense if they probably intimate or kind of a little bit more of a dovish stance possibly, and then get themselves in order and start to cut. But I think the cuts have to come. I think they have to come. I don't, we talk about the amount that just on a debt level and a servicing level for the short-term debt that we have, and you've talked about this. I don't see how with CPI on a 1.4% annualized path, how he doesn't cut rates at this point, especially with the debt issue and the servicing issue. I just see it coming. I don't know. And it feels like the market is, whether it be retail or not, the market is definitely, because remember, retail's buying, institutions are selling, but they're not selling enough to press. So there's definitely some positioning here where people aren't willing to sell at much lower prices. They're willing to let them go on the way up and de-risk. But what do you do here? They're not really pressing. So I could see that. I could see them taking a little bit more time to get in order and then start cutting rates in the coming months. That makes sense.
So from from the perspective of a financial institution, then if you do get a rate cut, and even if it's not today, let's say it's at the next meeting, whatever, let's say sometime in the next meeting or two, we get that rate cut. If treasury yields are basically, stand pat, you're looking at a situation where financial firms can borrow from the Fed and arbitrage treasury yields, right? They'll borrow from the Fed and literally just turn around and lend the money to the treasury, and we'll make money on that.
Yep.
I mean, that's kind of the crazy situation we've put ourselves in. Is that something you anticipate would happen, or do you think that would cause enough of a flood of liquidity coming into the system that it'd help bring down those treasury yields?
I don't know. I mean, it seems like it's by design, right? There's been a lot of things done by the Fed to kind of help the banking system, and they're paying them interest on reserves that they shouldn't be paying interest on, but they're getting paid to park money. So honestly, nothing surprises me at this point. It really doesn't.
Mm-hmm. Yeah, because if they pull down that Fed funds rate, right, that's going to pull down the interest rate on reserves, but it also pulls down the reverse repurchase agreement rate.
Yeah.
So it really does feel like banks who are currently, I mean, it's effectively lending to the Fed, right? They have money parked at the Fed and they're getting paid for it. I mean, that sounds like lending to me. Again, effectively at least. Yeah. They'll just simply stop they'll simply stop lending to the Fed and lend to the Treasury instead. But then again, it unless I have the math wrong, it seems like enough, even just a 25 basis point decrease in all of those interest rates would be enough to not only stop lending to the Fed, but to start borrowing from the Fed in order to lend to the Treasury. Crazy.
Yeah. I mean, you're outside of my box, but I'm following you, and it's a crazy thought. We'll see how it plays out. Definitely. EJ, thank you, my friend. Always enlightening, always one step ahead, and best dresser in DC or Wall Street across the board. So thank you, sir. I will wish you a good afternoon, and I will talk to you soon.